let's get in a global view going. David Roche, he's strategist at Quantum Strategy, joins in right now on the show to talk about his thoughts of what's happening around the world and predominantly what's the risk premium that investors globally are attaching to what's happening currently in the Middle East. David, great having you. Thanks so much for taking the time out and speaking to us. Could you tell us if the markets, which now seem to be getting used to geopolitical stress, are or could get ruffled if indeed the length of the current Israel-Iran conflict were to continue for longer?
I think the key issue is that if the oil supply is interrupted, then the markets will worry, because that is the umbilical cord which links the Middle East war to the macroeconomy and to the markets. So you have to ask yourself what President Trump is up to, and your idea is as good as mine. He's on, he's off, you don't know what he's doing, and you have to take for a given that Israel has changed its objectives and that it is now looking for regime change in Iran, and regime change could mean that a desperate declining, dying regime of mullahs could act so as to interrupt the oil flow through, for example, through the Red Sea. That's the biggest risk, I think.
Okay, David, hi. Good afternoon from where
Hello.
We're sitting. So, you know, important point you've made about the dying regime. Now, here is the question: is there a sense of finality of what we will see in the next few weeks? That one way or the other, this, you know, is something which will be resolved, or is there a sense that this is a conflict that could drag on? Because that is the worrying part as far as global markets and asset classes are concerned, isn't it?
Well, yes, and if the Israelis are left alone to bring down the Iranian regime, obviously the Israelis have a lot of firepower, but they have a lot less than the Americans if they decide to join in the killing off of the Iranian regime. So the long or the short question on the duration of the war is really one which depends on the amount of military might that is brought to bear. And I would have thought that there are two questions here. The first is, how long is the war? And I've told you what I think is going to be the determinant factor of that. But the other is, how much damage does the war do to the Iranian production of oil, and indeed the possible interruption of oil flows from Saudi Arabia and the Gulf states if Iran decides to take them on as a part of the enemy. We don't know these questions. So your question is a very good one, but it has two parts. One is, how long does the war last? Depends on the firepower. How deep is the damage? And how long does that damage last, even if the regime is toppled? We don't know the answers to those questions, but certainly at the moment, I would say the market's anticipation of the outcome is relatively benign, and I wouldn't be convinced of that.
Okay. David, what's the view on emerging markets right now if you're looking at what's happening with India at all? Because India, you know, strong domestic flows, buffering up the market, economy looking positive, and relatively seems insulated with everything that we're seeing.
Well, that's the great advantage of India, isn't it? It's not really enormously affected by anything, except, of course, if Trump puts on his punitive tariffs in July. And the other factor, I think, is that money is coming out of the dollar. If you look at China, which has been draining capital for many, many quarters, they had a $32 trillion capital inflow in the latest available month. So money is going back into key emerging markets, which are considered not to be immune, but to be better able to survive even a tariff war, and certainly a war in the Middle East. So that'd be my view.